Well, good afternoon, investors. Welcome to our October 22nd, 1 week before, a couple days before Halloween for this year. Our bull sessions is basically focused on our hunt for small company opportunities, best small companies for this year. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. I'm joined here by my dear colleague, the magical mathematician from mid-Michigan, Ken Kavula. I left out a couple
Hello,
adjectives there.
everybody. Glad to be here, as always.
And then we also have Houston's Matt Spielman joining us. Good afternoon, Matt.
Good afternoon, Mark. Good afternoon, everyone.
And hanging out with us here in the stacks, and you'll see why we brought up the stacks, is our dear friend, Mr. Kevin Gillogly, formerly of Illinois, but now of the Potomac land of Nirvana out there, Kevin Gillogly.
Well, I'm actually in Baltimore, which is about an hour away, but I'll take both of them.
Well, you know, when you're in the middle of the country, yeah, when you're in the middle of the country like we are, that's all, you know, we tend to think of it as one big Potomac Valley.
Just wait till you get to those Westerners. They look at even the Midwest as being tiny states.
All right. All right, so we are going to go back and going to kind of ram through a little bit of a lightning round, sharing where we find some ideas as we continue the hunt for best small companies for this year. We're going to feature the Hoover's book that we're going to go over here in a few minutes, Hoover's Emerging Companies, and we'll close out our conversation on IBD's New America as part of the session also. Anything else you guys would like to add?
Oh, if we do, we'll just jump in with it, Mark, okay?
Okay. And Ken and others have asked what's with the ghost in the middle of the screen. This is actually taken from a feature that's suggesting that we, and including college students, are not using libraries to the extent that they used to and probably should. It's a wealth of resources, and Kevin is going to give us a pretty significant reminder about that as we go through the session here today. All right, here we go. Just a quick stop in at Portillo's and our weekly reminder that Portillo's is not a sponsor of this session, even though they should be. And my cost to Portillo's stock price has not returned to my basis yet, as it bounced off of it recently. And we did have news that Houston, I believe, is opening a new Portillo's today, Matt, but it's not in your neighborhood.
No, that's in Southwest. It's an hour and a half away, but there are 4 total, and one is much closer.
Okay, so you're going to be Portillo's equipped and dangerous soon.
Yeah, they have chicken sandwiches. I'll get one of those.
All right, here's our reminder that no investment recommendation is intended. This is an educational demonstration. We are literally here, as we often do with these types of programs, we're here to share ideas. And in this case, the source of ideas for further study. And all of it rhymes and is complementary to the Modern Investment Club movement and literally 8 decades of lessons on how to discover an opportunity and how to analyze that opportunity. So you'll hear our opinions as we go forward. Please, please, please do your own homework about any stock that we mention. We'll be talking about real stocks, real time. Make your own decision after doing your own homework. If we own something that we're talking about, because frankly, Ken likes to brag about some of his recent purchases, we will try to remember to tell you. Again, form your own decisions about your investments and your investment related resources. Our 2 email addresses are there in case you have a request for slides, questions, or suggestions for future topics.
Hey, Mark, it's been about 8 or 10 weeks since we reminded folks that we do allow them to raise hands in these sessions. You have an icon where you can press the icon, your hand will go up on my machine, and I'll be able to see you, and I'll unmute you. You can speak directly to us. That doesn't negate the possibility of you using the chat box if you're more comfortable writing us a text rather than talking, but you do have the option of talking to us. Please be patient. Sometimes I will hold the hand until the speaker, whoever it happens to be, is at a place where I can interrupt them without causing too much a problem with the flow of the session. So use that hand thing. We enjoy it, and I think that it makes for an interesting presentation. We can hear you directly asking questions.
Fantastic. Thanks, Ken. Here's our weekly check-in on the stock market. Again, we use the value line arithmetic average as our stock market index. One of the reasons that we do that, just as a quick reminder, is that we consider the value line arithmetic average, which is an equally weighted index of approximately 1,700 companies. We consider that to be an all of the above index, in that it's got some smaller, faster growing companies, some medium-sized workhorses, and some very large blue chip companies amongst those 1,700 companies. So as that is what the green bars are, and you can see that the last one on the right is a work in progress, which is actually edged up above that trend line, which is formed simply by a regression through those green bars, which again are the stock market, and you can see it's at a slope of about 11%. Okay, so that's all that is. The two other lines are forecasts. My par is the medium or average forecast of companies in the manifest investing coverage. That's the red. The goldish one is the value line median appreciation projection, which is shown in the calculation on the right. And the bottom line is that the average stock out there right now is running at about 8 or 9% for a return forecast. Anything you'd like to add, sir?
Yeah, I learned some interesting facts, Mark. You told me just in a source just within the last day or so that in the last 12 months, the stock market has appreciated about 40%. Is that a correct number?
Yes.
And I'm looking at Value Line that's telling me that in the next 3 to 5 years, I should only look for 40% appreciation. So Value Line's looking for things to really slow down, aren't they?
Well, things have been quite rapid. So yeah, it's the market has been on quite a run from a tough moment about 6 months ago, and then if you go back 2 years, there was a bit of a moment.
I think the other thing that's worthwhile is that if you look at, you have the calculation below that 40% on the right-hand side, 8.7 is just a little bit below what the historic average is, just a 1 basis point probably. So that's probably pretty closer to normal.
Absolutely. Very much so. All right, and speaking of, well, what do we got first here? Oh, just checking in real quickly on our performance perspectives. We do have the Investing Roundtable, which is our community-based demonstration of people coming together, sharing ideas, right down the middle of that chart, actually at the top of the chart for that demonstration. That'll be next Tuesday night. But the stocks that you see mentioned there are our top 10 most widely followed companies by our subscribers. And a little bit of a recovery in that Russell 2000 growth, but it continues to lag. And again, I'm not taking sides or being political at all. Had never noticed that the 4 letters in our top 4 stocks actually do make out that acronym. I think I like that version.
Click.
If you're dyslexic, it does. Yes.
All right. I'm going to keep going before I get in any trouble here. Here's our groundhog update. Our weekly groundhog update. The market again has been strong. Groundhogs have been doing pretty well. They're up to 15% collectively. And Kathy Wood continues to languish. The monkey, by the way, has dropped all the way to 76, so I can actually see him from where I'm at.
So does that mean he's still ahead of you, Mark?
A little bit. A little bit.
Okay. All right.
But I am still in the top 100, and Kevin is close to my standing, so we're together. We're together.
It means, if you're below Mark, you're below the Mendoza line for those people that know the baseball reference.
I count 14 clubs in the top 40, Mark, and that ties the record for the number of clubs in the top 40. I'd love to see this get to 15 before Groundhog Day. It'd be great. A lot of Michigan clubs. Shout out to the Michigan clubs. There's a whole slew of them in the top 40 here. They're making up 10% of the top 40.
Yeah.
Well, if you're gonna boast for Michigan, I see Ty Hughes is in the audience. We got to give his family club Moose Pond down there at 36
Oh yeah.
a shout out too.
Good solid showing, and then we also need to toss kudos in the direction of North Carolina and Sandy Castor's son Alex, who moved from 40th to 22nd in the last week. So good stuff.
And we're getting our audience, we need to mention that Kim, who's not with us today, she's off somewhere doing something fun. Kim has moved into the top 10 again. She's been bouncing in and out of the top 10 now for the last 5 or 6 weeks, and she's back at number 10 again.
Yep, some very familiar names up there at the top, including our Bower City ladies, 3-time champions, and a threat to win it again. And again, we don't even talk about Jim Gallagher anymore. He's in a world of all of his own since he reached escape velocity with his extra planetary stock. So good stuff. And tip of the hat to Janet Blazer at 26 too. That's our Blazer index, embedded index. All right, I thought this one was kind of fun. It's again, talk about keeping things in perspective, and this goes right with your comment a few minutes ago, Ken. Ben Carlson's pointing out that maybe you should be careful taking the stuff that you read too much to heart, because 2 years ago, and if you think back, it was kind of a rough moment, at least emotionally and expectations wise, and 9 out of 7 economists were predicting a recession. And Ben is just having a little bit of fun here that, gee, after that dismal forecast and a kind of a run for the hills moment, the market's only up, 30.2%, annualized, actually a combined 67%, but 30.2% annualized. And that's just an amazing number. That's the graph on the upper right. He compared it to a moment like the death of equities cover. If you're not familiar with that, that's from about 45 years ago. Cover of Business Week. That's before my time, Ken. I think. Were you investing at that point? Or?
I was a brand new investor in that general period, Mark, and it scared the death out of me, I'll tell you.
Yeah, that was right around 1980-ish, I think. And it was really a rough time for investors, even though, and we pointed out many times on the pages of Better Investing magazine, if you were investing regularly from 1974 to 1980, you actually had a pretty good run. And especially if you invested in any of the community favorites that were back in that time frame, like a 1974 Coca-Cola or a 1979, I can't remember exactly which one it was, but it was a women's apparel stock that just went crazy.
Chico's fashion.
Yeah, could have been.
Chico's, Mark. It was CHS.
Chico's, yep. So they had a
But you could have also owned Jones of New York, which was another one that was going well at that time. And the reason I know those two names is we owned those two names in one of my investment clubs. As a brand new investment club, we were owning those kind of names. So, Mark, I know that if it happens to me, it happens to people in our audience. And when I saw this slide for the first time, I thought to myself, oh my goodness, we have another Cassandra yelling at us from the top of the ramparts right now. And then I noticed that this is a 2-year-old headline here. So folks, this is coming to us from 2 years back when everybody was telling us what was going to happen, that the greatest thing that never was. So
yeah, it's not a current situation. Ben is carefully pointing out that this is 2 years ago. The investing landscape was pessimistic. Let's just put it that way, quite pessimistic. And that didn't work out very well for the pessimists. All right, let's keep pressing on. This is, again, another chart that we just love to point out. Basically comparing bull markets to bear markets, because we are literally at 2 years of bull market now on the far right-hand side of this chart in that blue area. And then as we point out, much of the financial services industry is out there trying to protect us from these red dips down at the bottom. And again, in our community, we actually don't even want or need that protection. We just want to invest regularly, and it works out pretty well for us. In fact, if you go back, the only part, I mean, maybe this is where much of Wall Street learned how to do what they do. You know, this box right here, because there's a whole lot of red, very close to the Great Depression and the stock market crash back then. My solution to that is just ignore it, because there were substantial changes that happened during the 1930s with the Securities and Exchange Commission and other stuff. So again, when you hear me talk about investing history really starting somewhere in that time frame at the end of that area that I just crossed out, it's because the Investment Company Act of 1941 and everything else really brought sanity. And again, if you get rid of this stuff here on the left, just get rid of it. It's predominantly blue. And so this is our second slide in addition to our roundtable Microsoft slide where we say, what are you worried about? You know, unless you're within a few years of your life expectancy and you are in capital preservation mode, just invest regularly. Get out there and find a great company on sale and assume ownership of it. Is pretty much the way to go. What are your thoughts, Ken?
Well, my dad was a member of the Greatest Generation. He was a World War II veteran, and he was forever telling my brother and myself that you stayed away from the stock market. You bought U.S. government bonds, or you kept your money in cash. Occasionally, you kept a gold coin hidden somewhere in the house, maybe 3 or 4 of them. And he said the only way you get out of a really bad situation in the stock market is by having a world war. And that was his experience. And you're pointing it out exactly that the upward trending happens at the end of World War II and then continues through the early 60s. And then we have pretty regular recessions moving forward, with that exceptional long period of time in the 90s there where we had a nice stretch of prosperity, maybe something having to do with the Iron Curtain falling, you know.
Mm-hmm.
So
peace dividend.
Yep. So I agree with you, Mark. You know, there are times when you might want to keep a little bit of extra cash, but most of the time I like to have most of my money invested in something that I can trust is going to keep most of its value, even if we go into a recession like we've been in the last 3 or 4 or 5 times that I've lived through. I've lived through some recessions, and folks, there are some recessions that I've lived through that I didn't even know I was living through them until the recession was over. They weren't all like the Great Recession of 2007-8. They just weren't. Even if they were longer, they weren't nearly as hurtful as that Great Recession was in 2007, 8, 9, that period of time.
Yeah, and even that, we were back to even in our portfolios in 3 to 4 years. And this moment that Ken is talking about here, that is literally thought of as the worst moment for investors in stock market history because of the depth and suddenness, the severity of it. So it was a nasty moment, but boy, if you were working a day job and not really listening a whole lot to CNBC, you had much less impact. So good stuff. All right, so keep it all in perspective, invest regularly, all that stuff is true. And now one last quick story. I mean, I've told it a few times. I'll tell the nutshell version of it. Tom O'Hara once told me he had one bond in his lifetime. I asked him why he had that bond. He says, because I can't find it to sell it. And so he literally was 100% invested in stocks his entire life, with the exception of that one bond that he couldn't find. So good stuff. All right, so let's go ahead and switch gears to our topic for today and next week, and for our Saturday morning session on, I think it's November 2nd, Best Small Companies, our quest for 2025. And you guys have all seen these quotes over the last several weeks. I like the first one, obviously, because Ken's here. But the second one, Ralph Wanger used to run the Acorn Fund out of Chicago. And that's a pretty good reason to like smaller companies. You can have a lot of fun. And a couple weeks ago, we had Diane Grace. And when I was talking to Diane, and as we were doing some of the prep and the setup for the session, she was just giddy over some of these smaller companies that we have tinkered with over the last few years. And, just watching them go up, 100%, 150%. There are no guarantees in the world of investing. You guys all know that. But it sure is fun when those type of fortunate rewards come along.
And I'll remind you, Mark, that there is one guarantee. The most you can lose is whatever you invested. You can't lose more than you put in. That's a guarantee, and that makes the case for investing when you put it in those terms. If you invest $100 and you're going to lose $100, the upside to that $100 is unlimited. You can make 2,000 or 5,000 or 10,000 with that $100. So there is a guarantee, but it's not a very nice one. It's not a very nice one, and at the same time, it sets the reason why we invest in the first place.
Absolutely, and we'll probably cover that in greater detail at the next roundtable also. All right, so let's go ahead and get underway. This is, again, our excursion through these types of sources of ideas. We've covered a few of these in the last several weeks. Today, we're going to focus on Ken's favorite subject, the banks down there, shown by the Monopoly Banker. Then we're going to spend a few moments with Kevin Gillogly and the emerging companies featured in the Hoover's Handbook. And we will check in on Ken's favorite screen just to make sure that nothing's going on there. A little bit of Investors Business Daily. And then we'll conclude the lightning round next week with finishing out some of these that we haven't covered completely as we build out our shopping list for our companies for 2025. Well, here's the list, Ken, for this week. I don't think there's any changes there. Do you remember, or is that those have been pretty steady?
I think we've lost one or two companies on the list, Mark, but it's basically the same as it's been for the last 5 or 6 weeks. And that TBBK continues to stay on the list. It's an extremely interesting bank. We are now going to be covering it in the Manifest database. And I think that, folks, you need to take a look at this bank. There's the criteria up there that are used. I would love to have some control over the criteria because I'd love to, for a bank at least, I'd love to be able to move those sales up to be maybe a little bit more robust than is indicated. And I'd maybe like to base this on assets rather than sales when we're doing all of the work for the banks. But other than that, I'm using the list for ideas, and TBBK is a great idea. So is the Descartes system, by the way. That's a company, a European company that you can buy here in the American exchange. You might take a look at the Descartes Systems Group. They are a player in a lot of modern buzzword kind of things. I've been talking to Betsy Wills about Descartes Systems, and if you mention a buzzword, Descartes is probably a player in that buzzword. So take a look at it.
Pretty sure that they work with some of the robotics companies around here. They do have an office here in the North Detroit area. So
yes, absolutely they do.
Okay, so again, the bank kind of kicks us off here, and this is where things get a little bit exciting with banks. Whenever Natalie needs Ken to get away and stop bothering the workers on his deck, she just asks me to ask him for, what are your favorite banks right now, Ken? He starts to drool, and then he goes off and he does his thing. Well, here's the long list that he came up with based on.
Well, I asked Mark. I'm a very careful listener to people in our community that know something about banks. I approach banks as kind of an amateur. I approach banks and I like to try to understand the balance sheets. And I'll be the first to admit that there are banks where I cannot understand what a lot of their business is. You talk to me about JP Morgan or Goldman Sachs or Wells Fargo, and there are pieces of their business model I absolutely cannot understand what's going on. I like to stick with banks where I understand the business model. You know, you loan people money and you charge them a particular amount of interest, and you take in money from other people and you give them a certain amount of interest. And the difference between the interest you charge and the interest you give away is what you make in profit. Now, that's a traditional bank, a community bank. That's the kind of bank you saw in It's a Wonderful Life. And a lot of these regional banks have business models that are almost as simple as that. I like to listen to our community because we have bank examiners in our community. And when they tell us that one of the most important criteria for measuring the success of the bank is return on average assets, or ROA, that's the last column up there. When they tell us that's one of the things that a bank examiner looks at almost first as they're going in and looking at a bank, and then when they follow that up with saying, and look at the growth in loans, because loans are the lifeblood of any bank, and they should be growing as quickly or more quickly as assets are growing. So I asked Mark to go through his Y-Charts database and give me a list of smaller banks that have ROA above 1.5, and he went down to 1.46 down there. And I think this is a wonderful, wonderful list to start your preferences on. Notice that the asset value, and do we have an asset column on this chart? We don't. Okay, so
income is book value, and those are
okay. So there's book values per share, but I'm gonna go out on a limb and tell you that most of these banks have asset values that are less than 10 billion.
That's true.
And our bank people tell us that 10 billion is about the dividing line between what they would consider a small bank and a medium-sized bank. So somewhere in that $10 billion range for assets, not sales, but assets. And a bank and an insurance company and a lot of these other companies are asset-based fundamental corporations, and they have to be valued just a little bit differently, although you can keep it pretty simple and look at some of the same things we look at when we're looking at a plain old SSG, stock selection guide. So there's TBBK.
Down the middle.
I should tell you that the average bank's ROA is about 0.85. So you see that these banks are all well above average. And when you get up to 1.25, that's usually a dividing line between really good banks and superb banks, excellent banks. And when they move up to that 1.5 or above, you're looking at some of the best banks in existence at that point. So TBBK is sitting on that really great banks list right there. Western Alliance, one of our community's favorites, is sitting with an average return on assets right now of 1.49. That's pretty darn close to 1.5, so I'll take it. So it's on this line also. It might be getting just a little bit too big for us to be considering it as a small bank anymore. So I think we should be off looking for banks that maybe are small and come up on our SSGs as buy. Another community favorite from a couple of years ago was First Financial, FFIN, and you'll see it up there above TBBK with a return on assets average of about 1.8. So you can see why we pick banks like this. We've been talking about a number of these banks at various times. Right before the session, Kevin just mentioned that he owns East West Bancorp and how happy he is with that. And there again, look at the return on assets of East West, 1.57, and these are 5-year averages. These numbers might vacillate year to year. They're not going to be consistently up or consistently down. They might not even be consistent depending on what's happening in the greater economy. But these 5-year averages tell us an awful lot about how how much quality the banks own. Another bank we've talked about for many, many years, and it's always in our top list, is OZK, Bank of the Ozarks, up there with a 5-year average above 1.8. So I took this list and I started just doing grunt work, and I did down and dirty, I call them SSGs, and I took the list and came up with this list of banks right here. So that's about half of the former list. And now these are the ones, and I'm going to add one to this list that we didn't have on it. I'm going to add a BFC. It's the Bank First Corporation. It's a Wisconsin bank. And I'm going to do some SSGs on these and try to figure out which of these I think have the greatest potential going forward. Morningstar seems to think that many of these really high quality banks are already pretty fair valued. Check that column out. And Value Line, when it follows a bank, is telling us that some of the high quality banks, there's only 2 of them that it actually follows in the main Value Line, but it's telling us those 2 have Value Line low total returns that are probably not acceptable for our best small companies list. But the ACE numbers are notoriously, what's a good word, Mark? Give me a good adjective for ACE numbers.
Optimistic.
Optimistic or crazily optimistic sometimes. So when they're telling me that they think the banks are pretty fairly valued, I think that means I'm going to have a difficult time of finding a bank that I really like that's also in the buy zone. So we'll have to see. We do get some extremely nice par values from the top of that list. They're borne out by our proof values. Look at how closely those proof values tend to track the par values there. And I'll be reporting back in the next couple of weeks on which 1 or 2 or 3 I think might be candidates for our list.
Absolutely.
Mark says that we skipped NBN last year. We kind of passed it up. The bank that we did put in our list is doing quite well. Don't feel sorry for us, but we skipped NBN, and it's had about a 100% appreciation in the last year, which would have made it a really nice thing to have on our list.
Yeah, we should have warmed up to that
catch them all. Yeah. Can't catch them all.
Should have.
So,
it's kind of a hot one. All right, so we'll look forward to what we whittled this list down to. A couple of them, 2 or 3 for the list. Axos is always a finalist too. All right, so with that, anything else on banks, Ken, or should we move on?
No, I think that was enough to bore anybody on banks. Okay.
Oh, we're not bored, Ken. You know, we are all drooling right along with you. And yes, Kevin, I am still holding my shares of Western Alliance. So.
All this week?
Isn't that
All
the
this week? Own it.
Yeah, for more than a week.
Commercial that banks are boring?
Oh, I don't know.
You haven't been watching any football?
We might have to look that one up.
It's a good commercial, Matt. I know exactly what you're talking about. Yeah.
Cool.
They're making a play on the fact that they are a boring business, and they should be.
Which bank is the commercial format?
PNC, I think.
Okay.
Oh, yeah, no, I have seen that one.
All right, let's go ahead and move on, guys. Kevin has some thoughts to share on this Hoover's Handbook of Emerging Companies. It's a source that some of the best companies that I found in the early days back in the 1990s with our Chicago-based investment club came from this source. So I'm really happy that Kevin has kind of revived it here over the last couple of years for us. So with that, Kevin, I think we can take it away.
Thank you, Mark. Yeah, when I came in around 2000 or so, there were people who were talking about Hoovers. And so what I want to do is I want to show you some cool ways to sort of use, to find stocks through your public library. We want to be, thrifty or cheap. We want to be efficient in what we do, and sort of a way to sort of take a look at this. And I'm going to also call out the other people in the back room, Matt, Mark, and Ken. And if along the way you want to sort of say how you do things, because just because I do it doesn't make it true. It's just, this is one of the ways I use it as a possibility. So let's go on to the next one. And so, like I said, maybe we're cheap and stuff like that, but you're already paying money to your local government for your libraries and stuff. So why should I be able to sit there and spend money on a specialized and really an expensive business publication, no matter how good it is? And if it helps me make money, then so what? But the thing is there's a lot of business resources out there, that you can get at your library beyond the Value Line, the Morningstar, and the CFRA. And so there's this whole online database. I'm going to show you my local library here. But here's the other things to keep in mind is that, Ken talked about this, I don't know if it was last week or 2 weeks ago, you go to your local library and talk with the reference librarian or business librarian and say, hey, what do you got? And if you find some stuff that is kind of interesting, maybe you take your club and you have a special day where you go there and just sort of learn what to do it. Mark and I were talking about how Michigan has a state consortium. Maryland does too. Anywhere in Maryland, you can get access to what I'm going to show you. And the others that come to mind to say, oh, maybe I don't have it in there. Check with your college alumni association. They may be able to give it to you because you're donating to your alma mater. And if you're doing it with appreciated stock, you're even paying, not even paying full bulk for it, But also consider your community college. They may have some access there too, because again, this is money that you've already paid for. So keep those in mind. Are there any others that I'm sort of missing, guys?
Kevin, my mother-in-law was an archivist for the college library where Natalie and I went to college. And she frequently got phone calls directly with people that were alums that were asking to use the library facilities. And she said, I never turn down an alum that wants to use the library. So if you're an alumni of a particular college, even if your alumni association doesn't have something formal going on, I think it pays to call somebody, maybe not at the very top of the hierarchy, but maybe somebody down in the archives or somebody at the circulation desk and say, I'm looking for this kind of information. Can you help me get a hold of it in the library? And if she's any indication of the helpful qualities that librarians have, I've mentioned many times that my Wolves Club has 3 librarians in it. So I know what I'm talking about with librarians. They're really helpful people.
Mm-hmm.
Call them directly. They love to do presentations and to help individuals. That's what they live for. They do not live for running around chasing teenagers around and telling them not to chew gum. So,
or collecting book finds on the ones that Kevin keeps too long.
yeah.
Like in the Seinfeld episode, right?
The Bookman.
Yeah. So here's the Baltimore City Library. It's named Enoch Pratt because Enoch Pratt and his wife, they had no kids, and they were a big merchant back in the 19th century, and they left like $2 million to get our main library started. And I looked at, if you use an inflation calculator, it's about $50 to $60 million now. And so we have a lot of this availability. So again, it may be different at your library and stuff like that, but you can filter, as I have done, where the green circle is on businesses, investments, and grants. Sometimes you're going to get stuff outside of it. And as you can see right above the green circle, there's again what Ken just talked about, where it says contact your librarian to be able to get assistance and stuff. So keep those things in mind when you're doing it. And sometimes you're going to have to poke around. It may not necessarily always show up right away for you. Let's go to our next slide. So here's some examples of what I could find just through my library card. Business Insights, Gale Group, Merchant, S&P company information, not just the CFRA reports, but there's a lot of company information through the Net Advantage if you have that, and Reference Solutions. So you can find a whole range of stuff here. So let's go to the next slide. And I'm not an expert on all of these, but just, I've learned just like everyone by going out there and trying it. So it was Ken who was, Mark who was talking about this a couple years ago, where he was lamenting he couldn't get the Hoovers anymore. And I was sitting right here in this seat, and I looked at my library, and sure enough, by poking around a little bit, I found it under merchants, and it's under the archives where I have it highlighted in yellow. And it's older stuff, but the thing is that it gives me some really good information, and I'm like, okay, let me learn how to use Hoovers a little bit more. Let's go to our next slide. So here's Hoover's emerging companies, and I have a hyperlink. And again, if you want these slides, just reach out to Ken or Mark. So it's a business database. It started about the same time this guy started this online book stuff in the Pacific Northwest called Amazon. And so Hoover's was doing this. They were in Austin, named after Gary Hoover and his partner. It was acquired by Dun & Bradstreet, and at some point, Dun & Bradstreet was acquired by Merchants, which actually is part of, it's a subsidiary of the London Stock Exchange. Here's the thing, is that these publications, they have 4 different Hoovers: the American Business, the World Business, Private Companies, and Emerging Companies. If you look at that sort of red, that screen capture in the red box, if you wanted to buy all 4 of those, it would be like $1,100 per year to be able to get that. Now you can do that, but like I said, you want to be thrifty and use what you already are getting. The blue highlight, that's the latest Hoovers, and it's $320 to get the latest one. It comes out in the spring, and it's for information through the end of the previous calendar year. So the one that came out this spring would be through December 31st, 2023, and the like. What I'm going to show you is actually an older version, but as Mark and Ken have talked about, if these are good companies, they're going to be just fine if you're missing out on a year or 2 of recent stuff, because we're just trying to find out what these companies do. Let's go to our next slide.
Yeah, and one other point, Kevin, if you go back, subtract a year or 2, find the Hoover's Handbook from 2022 on Amazon, a lot of times that price tag is like $5. So it drops from that $1,000 or $300 price level down to something that you can get your hands on pretty easily. And I've actually handed those out at clubs. So even though if they're a year old, it's not the end of the world. They don't change that much from year to year.
Yeah, so let's look a little bit about Hoover's. Slow down a little bit there. So this is the handbook that comes to it. It comes as a PDF for me, and you can see sort of the content that's over on the right-hand side, and it sort of shows you everything. And again, this is sort of my MO with any of these business databases, is try to understand who they are and what they're sort of about. Because just taking it for gospel on this is a great company, the great resource, try to figure out what's going on. But you can see they have a list of the largest companies and by employers and net income. What we're looking for, and you can highlight this over on the right-hand side where it says the company starting on 1. And that's where we're going for, is that there's companies between 1 and 581 that we're going to be looking for. But they also have it like listed by, by headquarter location and by executives. Let's click one more and we'll see some other stuff. So here's this stuff talking about merchants. I want to sort of figure out who's behind Hoover's. So here's a background on merchant. You can read it or look at it when this goes up on YouTube. Click the next one. And then this is the Merchant Business Press. And as you can see down there in the green highlight, it has, it's by FTSE, that's FTSE Russell. So this is the London Stock Exchange. This is the business database of it. Let's do one more click and I'll show you the next thing up. And so this is the sort of the heart of it. And this is the Hoover's handbooks and going with it. And when I was talking with Mark yesterday, he didn't necessarily know the methodology that was going on. Click on the next 2 one. We'll have one with red, and then click again, we'll have green. I'm going to show you that since it's kind of small and hard to read. Let's go to the next slide and I'll go through them all. So over on the left-hand side, so again, this emerging companies, 600 are in there. Sales between 10 million and 2.5 billion, based primarily on sales growth and profitability. Do we like that, Ken, when we have profitable companies?
Absolutely. Absolutely. Okay.
All right. It's rather subjective what they say, and they have to have at least 3 years of sales, so that should probably be good, and sustained annual sales growth of at least 7%. And look at that, Ken. Again, that final thing, they're profitable through the last year. So that means there's going to be a blue line on your SSG. Is that a good thing to have on your SSG?
These are the people I should adopt, Mark, right here. You know?
You've converted him,
And then,
Kevin.
okay. So here's the thing is if you look over on in the green highlight, it can tell you, I like what it's almost their mission statement, that first thing. We believe anyone who buys from, sells to, invests in, lends to, competes with, interviews with, or works for a company should know as much as possible about that enterprise. Bravo. And so you can see how it's broken out, and I won't go through all of it, but each of these profile features an overview of the company, and they give you some some really good information about the history of the company. Let's go to the next slide. So again, if you look at the Hoovers, when you're getting this, is that not all 600 companies have this complete write-up, and I'll talk about that in just a moment. Just by spot checking, I found somewhere between a third and 40%. So that means somewhere between 200, maybe 240, 250 of these have a detailed report, and I'll talk about that as we go through this. But here's some of the things that they put in the Hoovers. Basic financial information under this. And here's the thing is if you see under their financial operations, they'll show what percentage operations are of this particular product or that particular product. Someone's done all that work for you, so I don't have to do it. They give you a thumbnail description, just like we see in our SSG, but they also give you a nice history. One of the companies I looked at, it was started by a social worker, 1-800-Flowers. I didn't know that. But they also have, and Kim would like this, is that with the executives, they show you what their pay is, what their age is, and you get an idea of that. And then they also can show you over on the right-hand side where I have the highlight under locations, is it'll show you sometimes their distribution. And the other thing is that as we were talking before we got started, is they show you competitors. I think one of the weaknesses with the SSG, even though we get those great list of competitors, we know most of the times they don't always match up as well. And here they're showing you the competitors. And this is important because, again, with these emerging companies, they don't have the same amount of coverage as we'd find in some of the other ones. Let's go to the next slide. So Ken talked about this, is that when we get a list like this, before I go too far down that rabbit hole, I want to spot check and see, do I see any names that look familiar? And I said, there's like 3 pages of company profiles. And I didn't even take all of the ones on this screen capture, but here we see Addis, we see Align Technology, Amphastar, Axios, Boot Barn, Brown & Brown, CBOE, Charles Rivers, and Copart. Those are, when I see those kind of companies, I'm like, this is the kind of list I want to start looking at. And that's how I'm going to sort of go through some of this. Let's go to our next slide. And so, like I said before, how do I use a database? And it doesn't have to be just Hoover's. It can be if you use other parts of Merchant or Gale Group or any of the others, anything you find through your library, because you may not have Hoover's, is that I'm looking for those smaller companies. And what happens is that usually they're not really covered by the main places that we go to the library, the Value Line, the CFRA, and Morningstar. And I'm trying to find the information. And if I do a simple search, and particularly if I use a ticker symbol, I'm usually going to get stories that start out with whether it's a buy, hold, or sell. I don't need that. I have the tools and the resources through both Manifest and the online tools to do that. So what I'm really looking for is I'm looking for an unbiased resource that can tell me how the company operates, its history, mergers and acquisitions, and stuff about the officers. That's what Hoover's provides for me. So let's go to the next slide. And before I go too far, anything you guys want to add at this point? Matt, you got anything you want to add?
You're on a roll, go.
All right. So now we come into this tedious part, and this is where Mark and I were talking about. You have 600 companies, and there's no screen to whittle this down. And whether we're doing Latsu, where it's 1,000 miles, journey begins with a single step, or the way you eat an elephant is one bite at a time, whatever it is, you've got to go through this. And let's go to the next slide. Mark, you can take this one.
Yeah, in fact, I had done a presentation about 7 or 8 years ago at the National Convention, and it was about Warren Buffett's early days in investing. And this was actually an interview from, I want to say about 20 years ago. He was talking about, well, if he were, a brand new analyst or a brand new person in the investing field, what would he do? And this interview with Adam Smith is pretty straightforward. And he describes how he would sit as a 20-something aspiring financial person in the stacks of the library. At the time it was Moody's, I believe he was looking at, and Adam Smith pointed out, but that's 27,000 companies, and Buffett very clearly gives it the right perspective. Start with the A's, and he literally talks about in his biography, going through page by page, developing an understanding of every company, and I would submit that it's served him pretty well over the years.
So we can keep moving on, but yeah, that's sort of it. So here's the thing. Let's sort of look a little bit at Hoover's, and this is literally the first page of the company's stuff. So of the 600 reports, some of them are detailed and informative, and others are sort of bare bones, sort of like what you see with the Value Line Small and Mid Cap Edition. And let me sort of take you through. So the screen capture that's sort of in the black boundary, 1-800-Flowers. Like I said, they have their operations, the different product lines, their geographic reach, the history. This is where I saw where Jim McCann started out as a social worker, and he was doing this to supplement his income, where he worked for St. John's Home for Boys. And that's how he started. You can still see he's listed as the executive chairman there. You can see the compensation for everybody that's going on. You can see their locations, 1-800. If we go to the second screen capture over on the right-hand side, that's sort of in the orangish background, up in the upper left-hand corner, products and operations, that's the sales and earnings for 1-800-Flowers. So you can see from the different product lines that they're using, and they're the brands that they have, and then right below there are the competitors. So you can see that, and you get a lot of information. So it's these detailed ones that I'm sort of looking for. If you see the next one right next to it, and again, they don't have a page break, they just keep going, because this was set up in the format that you did things in the 1990s where you want to save space and you just sort of move everything up. But the next one is the First Colonial Corporation, and you can see they have a thumbnail, they have a little bit of information, but not as much. So what I'm going to do is I'm going to look for each one, starting with the A's, or in this case with 1-800-Flowers, and I'm going to look at all these reports one at a time. And I'll tell you, I've just barely have gotten to the middle of the C's. That's where I am right now. But let's go to the next slide, and I'll show you how I sort of put it together.
I didn't know they had Harry and David.
Yeah, see? And so what I do with all of my stuff is I keep a simple notebook. I think it's important. I'm sure a lot of you are listening to us, and Mark and I were talking about it. You may not even, if you have a pen, you may not have the cap off on it. You may not have a notebook open. But when I'm at these webinars or even in my own club meetings, is I get a notebook and I open it up. I have them for my clubs. I have one for webinars. And every year I start out with a new one. And so what I do is it's just a place for me to, instead of writing on the back of some mail I'm going to throw out pretty soon, is I just sort of keep it there so I can at least look back on it. So let's go to the next slide. And this is literally how I did. This is a screen capture. I know it's not as perfect over there, but I just went one by one, page by page. I started writing things that caught my eye. And, things started getting messy and cluttered. But, as we say with these notes, and again, a lot of people don't use a notes section in your SSG, look at the notes as a message to your future self. So if you see this screen capture, and you see over on the left-hand side where you have the spiral ring there, I basically was first looking for names that looked familiar. And I was like, okay. And then I was going down and seeing ones that if you see my handwriting, it said full to the left of it. That means they had a detailed stuff. I then started looking at sort of the numbers. But what I finally did is I highlighted the ones that I've actually done studies on. So it was like, okay. And then it was like, well, let me find new ones. Those are the ones on the right. And again, it gets really kind of messy and stuff. And you can see some that I've highlighted with yes, and I put a highlight through. Those are the ones I was like, okay, maybe there's something there. But as I went through this with each page, it started getting a little bit better. Let's go to the next slide. And so as you can see, I said, okay, here are the things I want to look for. So what I'm looking for is, again, these companies usually don't have a ticker symbol, and I'll tell you, I think that's good, and I'll tell you in just a moment why I think it's good. But I'm looking at the name, I'm trying to read the thumbnail and sort of, what the company does. And then I'm looking at, I go to the Better Investing and I open up the online tools, and I just type in the name of the company and I look at a visual analysis. I look to see what the financial strength is, the health grade, I should say, and then also where the price bar is. And any of those that look pretty good, I'm going to highlight in yellow. And again, being closer to the 52-week low is a bonus, but these are the ones that look the most promising. And I've got to come up with 3 new stock ideas to present to one of my clubs this Friday. So this is the basis for what I'm doing. Let's go to our next slide. And so here's what I did with this one. So here I am in the online tools, and you can see where I started to type in Cadence Design System. Can you highlight that, Mark, so people can see where we are? Right there. And again, I like it when I don't necessarily have a ticker symbol, because like I said, most of the times when I find reports or information that has a company's ticker symbol, most of it seems to just naturally gravitate towards investing terms. And what I'm trying to find is how the company operates, what it does to make it. And so I just type in the name of the company, I hit go. Let's go to the next slide and you can take a look at this. So here it is. Do you like those, Ken, are those good lines?
I like them, yeah.
Okay. And do you have a blue line there so we have some earnings?
We sure do, Kevin.
And then I also like to look at the financial health grade over on the left-hand side, the A. I did a thing for the Georgia chapter this spring or summer where I was showing you how to use this financial health grade. But basically, C or better is the top 70%. B or better is the top 20 or 30%, and the top and A is the top 10% of all the stocks that are in there. So this is sort of like a balance sheet metric. So between the financial health grade A, excellent balance sheet, and this visual analysis, the income statement, I feel like I've got something that I can now go back and use the detailed report to help me figure out more about Cadence. Let's go to the next slide, and we can also see it here. Here it is on Manifest. So again, just typing in Cadence or the ticker symbol, and we can see it has a really good quality. We can see it has a core score of 261. Do you want to point out what the metrics are to determine the core score, Mark?
Well, the core score is basically the sum of the quality, the financial strength, and the earnings per share stability.
Go ahead and check mark them. Go ahead and check mark those numbers.
Here is financial strength. Here's the EPS stability, and of course down here or up here better, the quality. So you add those 3 together and you get Kevin's 261.
So, and again, whether you think 250 or better is a core score or 225, whatever. And what's great about Manifest is we can see how this compares to those in the software application. And we can see it's a third one down after Nice and Intuit. So you can see it. And I know Ken likes to look at the Chronicle to see how it looks. And how does that Chronicle look to you, Ken?
Well, if I were looking to buy it right now, I like that consistent quality line for a for a reasonable period of time. It's consistent horizontal or moving up. That's good, and it appears to be trading at a price that's historically near the high that it's traded at as far as par is concerned. I said that wrong. The price is not high. The par is high, and that's where I would like to buy it when the par is high.
Very good. So here you can see just by using some data, public database that you may have through your library or through your college or your community college, that you can be able to find some of this stuff. And then we can use the information that we get from Manifest and from Better Investing. And I can be able to make a really good assessment that said, now I have some information about this company, because again, these are emerging companies. So they do not necessarily have, they may or may not, I don't know if Cadence has a full value line or some of the others, but the thing is that's usually the real problem we have with these smaller companies is finding out what they really do. And you spend a lot of time hunting and looking for that. And this is a way to do it. Unfortunately, as we said, you got to go through these one by one. It's not really kind of sexy. Let's do, I think we have one more slide and we're done. So here's a review of it. So what I do is I'll look at the detailed reports. I need that information in the case of Cadence to help me make my judgments on my SSG. I then pull up the online tools, see if it passes a smell test, and then I'm going to check the financial health either through the health grade or through the quality ranking and core score to see whether I like this company. And then from there I go, okay, is this worthwhile or not? I think one more slide and we're done. So what I was trying to do here is I'm not trying to give you a list of ideas. What I'm trying to do is show you how to feed fish rather than I'm not going to try to feed you fish. I'm going to show you how to fish. And so here's a really good place, I think, in Hoover's that we can be able to look at this stuff to be able to find stuff that's worthwhile for us. Any questions or comments from the rest of you?
I'll have salmon.
Okay.
No, very good, Kevin. I mean, I think this is a powerful reminder of the information that's here. I had actually been a little bit dismissive. I think there's a lot of information here. I did not know that Harry and David was part of 1-800-Flowers. I mean, just as one small example. Good stuff.
Mark, we're getting some comments from different audience people that their library system has many, many things, as does my library system. I noticed a considerable overlap between what my library has available and what Kevin's library had available. And I also noted that I had things that he didn't have. I think it's especially interesting if you find out if your library is in a statewide or even a regional kind of consortium of any kind. I didn't know until very recently that not only was my library in a statewide consortium for reference material, but it's in a statewide consortium for all of its assets. All of the things that are in the library are in the consortium. My wife, for example, can go on to the library site and tell them she wants the latest book by Jeffrey Deaver, and they will search through the entire state to find an electronic copy of that book, which she can then download. And if all the copies are out at that time, they'll put her on a wait list, not for just our local library, but for the entire state. So these kind of things are happening all over the country. Do check to see if your library system is part of a larger consortium of some sort.
Very cool.
And I would say on that one, the same thing is that, we can do so much of this online. Maybe take the time to go to your local library and introduce yourself, tell them what you're trying to look for, and talk with the reference librarian, even if it's just maybe the reference librarian isn't there, but maybe you can find, start building a relationship so those people can be able to help you when you go back on a second and third time. Back to you guys.
All right. So one of the things we did after Kevin gave me the copy of the book is I went through and I did, same way he did, went through and got the ticker symbols. And we cover a good number of these companies, and we're steadily adding a few of the more interesting ones. And this is sorted by manifest rank, which is, again, the return forecast in combination with quality. And again, since we're looking for companies that have attractive return forecasts and high quality, we're going to be shopping at the top of this list and basically going through and confirming we trust, but we want to verify. And there's a number of companies here. This definitely passes the Kavula test. A number of these companies he owns, so we know we're barking at the right tree at this point. I was interested to see that Diane's Shift 4 Payments actually makes this list. Ticker symbol 4.
The Mid-Michigan Model Club, Mark, just last night put Iradimed on its bounce list, IRND, about 5 above that one you just marked.
Yep.
There it is. Yep.
So these
I was going to say,
go ahead.
I'm seeing now Montgomery County Model Investment Club. We have XLS Services, the 5th one down. We looked at Paycom, but didn't take it. One of my clubs looked at Ollie's, owned it, lost it, and it's back up there. Iradimed's on one of my pounce piles for one of my clubs. So yeah, and we've also looked at ELF, Eye, Lips, and Face Beauty down at the bottom. So
and
Mid-Michigan Model owns MedPace, Mark, up there above Iradimed, about 3 or 4. We also own Excel Services, and we own Paycom in Mid-Michigan. So I'm looking at a list where I'm feeling comfortable by finding 3 or 4 candidates that I know about, and therefore I'm very interested in the rest of them. Mark has directed me to take a really solid look at Mr. Car Wash, so I will be looking at Mr. Car Wash here. Okay.
That's an Arizona company that apparently is growing by leaps and bounds, And if you're at all a fan of the Breaking Bad series, you know that there's money to be made in washing cars and
And laundering money.
and laundering money. And that particular company, I'm pretty sure I want to go back and look for the reference, was mentioned by Tom Lee, that the analyst that we kind of watch, and he's got a real hankering for these smaller companies. Yeti is.
Mark,
Go ahead.
Didn't we get double verify at the Bink, the most recent Bink, from a couple different people?
Couple different people, including Susie.
Yeah.
So, yeah.
Uh-huh.
So yeah, there's company MedPace is on the current list as well as Yeti. I think Yeti probably survives for another year. It's disappointed this year, but we'll hope for a better year next. So that's at the top of this list. It makes it a pretty strong candidate to make our final 20.
Well, and I'm going to focus on Pubmatic only because of the name, Mark. So
I would say one other thing, Victory Capital might not qualify for too much longer. They have now approved a merger with a subsidiary of Bank Agricole, one of the biggest banks in the world out of France, and the biggest. They just gained access for all their products to the biggest asset manager in Europe. So when you think about what their future is, if it's any kind of linear projection, that's not true. That's been approved. So they're going to swallow a big group of customers as well as some funds that go through. But interesting development on where they will go, and actually lines up very similarly to what I think is Interactive Broker's strength of non-U.S. customer access to U.S. funds.
Well, we have a nice list to go through here, Mark, in the next couple of weeks, huh?
Yep, and we'll be, filling out a few of the companies that are not covered yet, so we'll have a very interesting list. All right, speaking of other interesting lists, here is, we started this last week. The dashboard is here. It will be continuing to fill out the Investors Business Daily New America feature, and a few of these companies were not covered. And basically looking at companies that have been featured for the last 52 weeks. And the one that kind of pops off the list a little bit, that kind of surprised me, United Therapeutics, with a high enough return and enough growth and enough quality to basically generate this situation. Probably worth a closer look. Here is a look at the sketch of the business model, the visual analysis that we look at, and we notice a company with improving quality, an interesting situation developing with their sales trajectory. You can see that whatever flat spot they had for a period of years is now projected to improve. So maybe that's a story we want to understand. And as Ken said earlier, anytime we see a return forecast at multi-year highs, it kind of attracts our attention. So you can go back, just as shown here, and take a look at the companies that we talked about last week a little bit. Matt was high on this one. Understand better about Clear Secure, the TSA PreCheck company.
Yep, TSA PreCheck and now Stadium fast entry. You think they're everywhere, so you think it's saturated, but it's. I'm not there yet. I do not own it, but it's very interesting.
So
Mark, if we're near the end, I'd like to make a comment about the fact that if you're a big list follower like I've been for the last 20 years or so, and if you look at a lot of lists, I keep a separate list of companies that appear on a lot of my lists. And that short little list has given me some of the best ideas ever. When you start to see the same name pop up on list after list after list, that's worth putting on a separate piece of paper and looking at it very carefully, because that's making lists for a lot of different reasons. And that means you got a company that's maybe percolating in a way that you want to get involved with.
Yeah, and here's a look at the companies that would survive the screen today based on the screening criteria on the right. And obviously, we'll be adding more companies to coverage. Some of these will actually drop a bit on a update, but again, you see companies like United Therapeutics, and Double Verify showing up here. Axos, Yeti, and Nice. These are all repeats. We're put this one in the question mark category. We'll see how that one comes out. And a subscriber actually sent in Consolidated Water to be looked at closer, and it actually makes the list. So,
well, I will say, Mark, there's about 15 names on this list?
Mm-hmm.
And I have 9 of them written down that I have to do a little bit of dive in. So there's a lot of new names on this list for me, a lot of familiar names, but a lot of new names. And that's always a benefit of doing the work and finding small companies. Even sometimes you come up with things that don't make the final list that interest you enough to keep searching on it and keep working on it and adding it to your own portfolio, even if it's not on the list.
I do think we should probably say a moment with Nice. That's one of the Israeli companies that has been really in the doldrums for the last couple of years for a number of reasons. And there could be an inflection point with recent events in the Middle East. So could be some interesting days ahead.
One other thing, down at the bottom, oddity, I did that as part of the roundtable last month. That actually came from Pat Donnelly of Pittsburgh.
Yep, I was going to mention that.
And he's, it was a good one to take a look at. Now, as I pointed out, it's also Israeli based, but it's also only has a year of publicly traded data. So it may be a little bit too soon for some people. Pat really likes it. I haven't purchased it, but I really found it kind of an interesting setup. You can go back to YouTube and take a look at the presentation. But the thing is that even if it's not ready now, you can sort of keep it, as Ken does, sort of maybe keep it in mind and look at it, a year or two down the road, because if it's going to be good, it's going to be good long term. So, if you wait a year or 2 or 3, so be it.
Absolutely. Any other thoughts here, Ken?
Well, I'll just end by saying that my mom was 87 years old and still telling us she was investing for the future. So I don't think you're ever too old to stop looking for ideas.
Good stuff. All right. Here in the deck, the latest update on Buttonwood. I was with an investment club last week, and they were stunned. They had considered Schlumberger and kind of written it off. And when we were describing what we see as a bit of a renaissance or a turnaround at Schlumberger, it was a lot of fun to exchange some thoughts. And it's nice to see Schlumberger doing pretty well here, along with Green Brick and Gentex.
Mark, I know we don't have a column in here to show how much we've actually invested and therefore get a rough idea of how much we've made on each one of these companies. But at the present time, isn't Lulu the only one we've actually added to a second time?
That's correct. All the others would be a maximum investment of 162.
Okay, so we can kind of look at the percentage of total, and it will kind of tell us which ones of the stocks have been doing best in the near term, right?
Yeah. Everything above these is positive returns.
Yeah.
Except for Lulu.
And I'm not surprised to see some of those stocks at the bottom down there. So
just
not surprised
yourself.
at all.
Just
I'm not picking any names yet, okay? Yet.
Notice that there's a lot of potential over here for improvement.
Yes, but if we're going to get serious about making money in this portfolio, at some point you're going to hear it, okay?
Just behave yourself. All right, with that body slam, we will go on to remind that we do archive all of these presentations. So Kevin's artwork is preserved forever on YouTube, on the Manifest channel. You can find those sessions, and he was actually referring to a presentation he made. Was it during this one, Kevin? Yeah.
Yeah, it was.
The September roundtable was where he presented Oddity. Good presentation, Kevin. Good stuff.
A little on the long side.
A little long. That's all right. All right. For coming attractions, there's some stuff that we have in the kind of the wish list. Maybe a little discussion of podcasts, maybe a discussion of newsletters. The roundtable is next weekend, and we are going to be looking at that larger topic on the far right. obviously the next couple of weeks are focused on this critter and finding the best red rabbits. And that culminates with this session on November 2nd, Saturday morning, 10 o'clock Eastern time, when we will be going over the results from last year and our selections for next year. I will tell you that we're still ahead of the market, but our lead is shrinking.
Why do you say anything?
So I shouldn't say anything.
Right.
I'm not going to give any numbers. I'm not going to give any numbers. Is it too late? It's too late. I mentioned it, huh?
You've already jinxed yourself.
Damn it. All right. Well, I got a kick out of the slide on the right. The dinosaurs observing the sky. We know how that ended. And then the one on the left actually comes to us from a rocket scientist, Laura Scott, who a buddy, some form of time-lapse photography or artwork there showing the launch and the capturing or catching in the arms of that tower of that rocket stage. I think it's an interesting piece of artwork.
Magnificent is what we have to say about this whole piece of technology, Mark.
Yeah.
Can you imagine the hours and hours of thought that went into figuring out how to make this happen?
Yeah, Mr. Musk had an interesting week last week, for sure, or 2 weeks ago. All right, anything else in the hopper? We ran a little bit long, but I think it's well worth it. I mean, again, Kevin, thank you for the astounding reminder of the depth that's actually covered in the Hoover's Handbook. Those of you that are Manifest Investing subscribers, I did stick that PDF of the Hoover's Handbook in the forum, so you can do some perusing. And I would encourage you, as Kevin and Ken have both done, you might want to check your local library to see if you can get a direct copy of that, along with access to some other investing related resources. So anything else, sir?
Nope, just want to say goodbye to everybody and see you next Tuesday.
All right. Thanks, Kevin. Thank you, Matt. And of course, thank you again.
Bye, everyone.